The, this is the lecture of SY BCom Sem 3 Indian Financial System. In this lecture, I explain the first unit, that is Indian Financial System. First of all, what is Indian Financial System? According to one Professor Olson, any financial system consists of financial institutions, financial markets, financial instruments, and financial services. So, according to Professor Olson said, markets, institutions, and instruments are the prime mover of economic growth. Availability of capital is necessary for economic growth. This capital is the saving of the people transferred to industries through financial institutions like banks, insurance companies, and through financial markets like capital markets for long term and money market through commercial bills or short term. We can say the financial system may be defined as a set of institutions, instruments, and markets which foster savings and channel them to their most efficient use. From the above meaning, we can say, from the meaning, I can say that there are various characteristics of financial system. First is, it is system. Obviously, a system consists of a few components properly linked and coordinated with each other in such a way that the whole functions exactly as expected. Second is, it comprises four components. First is financial market, second is institutions, third is financial services, and fourth is financial intermediaries. So it consists four main components, or we can say there are main four components of it. Then third characteristics is regulated by various authorities. Financial system generally regulated by RBI and SEBI in India. All the banks regulated, all the public and private sector banks regulated under our central bank, that is Reserve Bank of India, and all the other financial institutions are regulated by SEBI. So financial system, we can say, regulated by various authorities. Fourth is economic growth. It is due to efficient and effective working of the financial system that savings of people are channelized into industrial investment. This leads to economic growth. So ultimately, for economic growth, more and more economic growth, or we can say a sound economic growth, depends upon sound sound financial system of the country. Now, next point is the components of financial system. There are mainly, I already explained in characteristics that there are four components of Indian financial system, that is financial market, second is financial institutions, third is financial instruments, and fourth is financial service. Now, in first, financial market includes or we can say financial market, the main function of financial market is to transfer funds from lenders to borrowers. So financial market perform a crucial function to link between savers or investors to borrowers. Thus, there are mainly two types of financial market. First is money market and second is capital market. In money market, generally the financial transaction is for short term or less than 1 year related transaction is called money market, or if any financial transaction is more than 1 year, we can say it is a transaction of capital market. So in money market is for short term related transaction, and in capital market is for long term related transaction, whether it is for shares, debentures, bonds, or etc., or any other instruments. Now, in money market generally refers to the segments of the financial market which enables this raising up of short-term funds for meeting temporary shortage of cash and other obligations. Or for a short term, any business entity wants to raise liquidity. The business wants funds for short term. Then that business is use the all the instrument of money market. So business so the business for a short term fund, any business want for a short term financial market which enables the raising up of short term funds. Then after second type is capital market. There are mainly two types of capital market. First is primary market and second is secondary market. So in primary market, IPO, FPO, etc., generally any corporate entity wants to raise fund for a long term, then business they go for primary market, and after second onward transaction of their securities they go for secondary market. So there are mainly two types of it, and their main players are individual investors, foreign institutional investors, merchant bankers, etc., mutual funds, etc. Now second component is financial institutions. The financial institutions are commercial banks, development banks, specialized financial institutions like export-import bank, etc. They pull funds from savers and provide them to corporate sector and other who need finance. They act as financial intermediaries, as they act as a middleman between savers and borrowers. There are different types of financial institutions. The main institutions is commercial bank, which collects the money in the form of various types of deposits and lend them to industry and trade. Third component is financial instrument. Financial instruments like shares, debentures, treasury bills, commercial papers, etc. are the main instrument of financial system. With this instrument, and any financial system or any financial activities will be done. So these financial instruments link savings to borrowing. Then after fourth component is financial services. Financial services are provided by financial intermediaries. Financial services can be defined as activities, benefits and satisfaction connected with sale of money that offers to users and customers. For example, banks are one of the financial services. Banks use various types of financial services like For example, open the saving accounts, current accounts, etc. Then after merchant banker, credit rating agencies, depositories, etc. Merchant banker generally gives various types of financial services to traders. Then after credit rating agency generally gives the opinion credit rating the all over the corporate companies overview. Depository, then after depository is also one of the financial services which gives the facility to deposit any financial instrument in their depositories. So these are the main four components of it. Then after pre and post liberalization. Pre and post liberalization system or pre and post history of financial system. Pre-reform period from before 1991 and after post-reform period is after 1991. So pre-reform period is we can say before 1991, after independence to 1991, that is pre-reform period. In that period, generally semi-organized and narrow industrial securities market devoid of issuing institutions and the virtual absence of participation by intermediary financial institutions in the long-term financing of the industry. However, in post-independence period, the period between independence, particularly after 1951, when planning was introduced till 1991, was marked by development of financial system, but dominated by government and public sector. Financial markets were characterized by control over pricing of financial assets like share, debenture, bank accounts, etc. Barriers to entry, high transaction costs, and restriction on movement of funds participation between the market segments. So, in 1955, generally establishment of various types of development banks between 1955 to 1964. In 1955, ICICI, that is Industrial Credit and Investment Corporation of India, was established in private sector, which was landmark in development banking in India. But the most important ever in development banking occurred in 1964 when Industrial Development Bank of India, that is IDBI, was established as a subsidiary of RBI. It not only provide long-term as a subsidiary of long-term and medium finance, but also coordinated the activities of all financial institutions. Then after in 1976, it was converted into a separate autonomous institution delinked from RBI. Then after other very important event where in the field of insurance, Life Insurance Corporation was formed in 1956 by nationalization of 245 life insurance companies into a single monolithic state-owned institution. In 1972, General Insurance Corporation of India was formed for general insurance. Then after in 1964, Unit Trust of India was set up. The objective of setting up Unit Trust was to enable the small investors to share in the industrial prosperity through indirect holding of equities. Now, after post-reform period, that is after 1991, after LPG policy in 1991, there are mainly three developments are occurred in Indian financial system. First is privatization of financial institutions. Second is reorganization of institutional structure, and third is investor protection. However, some developments are also occurred in money market after 1991. After 1991, SEBI was set up to regulate the all security market related transaction or security institutions, whatever the corporate sector generally does not depend on public sector and development banks, so they now can raise of money from security markets, and so it become necessary to regulate the securities markets. Hence, in 1992, SEBI was set up. Now, I explain the new concept. New point is organizational structure of Indian financial system. First is financial intermediaries. Second is financial markets. Third is financial instruments. In financial intermediaries, there are banks, non-banking companies, mutual funds, and insurance companies are occurred. In banks, there are mainly three types of banks. First is scheduled banks, second is non-scheduled bank, and third is foreign bank. In scheduled bank, there are mainly two types of bank. First is private bank, and second is public bank. Then after, in non-scheduled bank, generally cooperative banks and other developed and non-bank other banks are included. However, foreign company or foreign which are not indigenous bank, that are included in foreign bank. Now, non-banking companies. Non-banking companies, generally we can say non-banking financial institutions, generally gives financial services to business, entities, corporate sectors. Mutual funds, those who wants to invest in corporate or any other financial instrument with the help of experts. That type of investors use these mutual fund industries. Now, insurance companies. In insurance companies, generally in public sector, LIC and GIC are occurred. However, in private sector, HDFC, ICICI Bank, etc. are one of the example of insurance company. So these are all the financial intermediaries. First is bank, second is non-banking companies, that is non-banking financial companies, third is mutual fund, fourth is insurance. Then after second part or second structure of Indian financial system is financial market. First is money market and second is capital market. First is, I already explained the less than 1 year or for short term period money market is used, and for long term period capital market is used. For money market, core market, CP market, coal market or commercial paper market, commercial depository market, treasury bills, exchange bills, etc. are the example of money market. However, capital market, direct and indirect, there are mainly two types of capital market. Indirect, new issue market, that is IPO, FPO, etc. are the new issue market, primary market of primary market. Types of primary market. However, second type is secondary market. After getting second onward transaction of any financial securities like shares and debentures, they go for secondary market. So however, these are the two primary and secondary market are the two types of direct market of capital market. However, in indirect capital market, type of indirect capital market is mutual fund, security receipts, mutual funds and security receipts. That is two example of indirect capital market. Now, so these are the types of financial market. There are mainly two types of financial market, money market and capital market. However, in capital market, there are mainly two types of capital market, that is primary market and secondary market. Now, third organizational structure is financial instruments or assets. Financial instruments. In financial instrument, there are mainly three types of financial instruments. First is primary instruments, second is secondary instruments or securities, and third is derivatives. First is primary instrument. Financial instruments includes equity shares, preferences, debentures, new debt instruments, etc. However, in derivative, forwards, futures, options, etc. are the various types of strategies of secondary market which includes in derivatives. And second, or also it is one of the part of secondary market, secondary securities. So these are all the organizational structure of Indian fiscal system, or we can say Indian financial system. Now, at last point is role of financial system. What is the role of financial system? First is role as a mobilizer of funds. Financial system mobilizes savings of large number of people who want to invest their savings and get returns. So role as a mobilizer of funds. Those who need funds, they can get from financial markets, and those who wants to invest fund their savings, and they also get from financial system. They also and get returns of their capital. Second is role as a facilitator. Obviously, as I earlier in characteristics of financial system, I explained that it is a link between savers to borrowers. So it is ultimately a role of a facilitator. Third is role as a risk bearer. Risk means chance of loss. Risk of investors is managed by the financial services, that is mutual fund. That is mutual funds collect saving of innumerable savers and invest them in securities of variety of business enterprises. Fourth role is role as a provider of payment mechanism. Obviously, financial institutions like bank provides a mechanism of payment for exchange of goods and services. Fifth point is role as a provider of information. It gives various types of information, price related information to the participants. Which type of information? Finance related information, like how funds can be raised in business, which type of the avenues of fundraiser, etc. information will be kept by financial intermediaries. Then after role as agent of economic growth. Obviously, as I earlier, financial system enhance the economic growth, so it is one of the agent of economic growth. So these are all the roles of Indian financial system. So in first unit I explained the way all the main concept or points of Indian financial system, that is meaning, characteristics, organizational structure, role of it, etc. So now I end up this lecture. Thank you.